Right, Samir Arora joins us now. Let's say hello to him. It's time to understand that why markets this time have managed to climb the wall of worry. Samir, a saffron color shirt, I mean, that's like bravery.
Why bravery? Isn't that what everybody has to do these days?
It's about bravery. No, it's.
You know, he can say that because he's sitting in Singapore.
Yeah.
Why?
Don't try and put me in
Okay,
a spot, Samir.
let's
We
move
are
on.
supposed to question you, not the other way around.
Okay, Samira, put the news on one side. Interest rates will go higher. Crude touched 130. There is a war in the world. Margin under pressure. And FI flows have been volatile. That's the news on one side. And then if I superimpose with the markets are not far away from an all-time high. I mean, aren't markets supposed to react to news, macros? They say never fight the Fed, but nobody's talking about it. Interest rates are like gravity. If they go higher, valuations will come down. Kuch nahi ho raha hai.
So I agree with you actually. You thought that I will come and say that, wow, great, India is doing well. But I am myself confused. And I think that the markets have to respond to some of this. And sometimes they, get carried away in the short term. And the best example I can give is in 2008, where every second, third month, the market would be up 8 to 10%. And we would think at that time that maybe this is all done and dusted and this is all settled and discounted. And then I realized that no, the markets normally have some of these violent pullbacks. So I feel quite nervous right now. Quite nervous means nervous for the next 1 or 2 months at least, till I really believe that we are discounting not this year, but we have suddenly started discounting 23 and 24 straight away, which normally I don't believe we do. So I feel a bit uncomfortable with the current level of the market.
This is the best way to maximize because markets go higher. So if you sell, it's not a great strategy. But if you don't sell, that's also not a great strategy.
No. So the strategy is, first of all, that when people say that, if you had SIPs for 30 years, it would not matter. I just say that to go through this time, if you hold back, not that SIP you're going to change, but what I mean is don't think that every second, every day is good for the markets. At least as a fund manager, I have to think like that. The end investor who is not so close to the market may say that this is my asset allocation and this is my SIP plan and I am putting X amount every month and I am putting it for 5 years and 10 years. I totally agree because I myself am also an investor more than just being a fund manager. But as a fund manager, I can't say every day, every second that every second is a great time. So we say we will take some 1 week, we will take 15% cash in another fund, our 60% has become 45% net, because we will try and go through this period to the best of our ability. And in the end, in 30 years, it will not matter whether I did this or not, but we have to, sort of do the best we can in every period that we can. I can't myself say to myself that don't worry, whatever I do now will not matter in for the if I'm still managing this fund after 25 years. But to an investor, that is how it is done, and he should continue with his longer term plan. And the fund manager has to maneuver both the short term and the long term.
Good morning, Samir. So as the long-term investors stay invested and the short-term investors navigate through all of this volatility and the markets pricing in at least the worst of the war behind it, I have a very basic question. With the inversion of the bond yields and the way the stock markets are going up, is this a bear market trap?
Well, it could be, I don't know, because last month has been so shocking in terms of how the US markets rallied even in the face of US hikes coming in, and then the story being spun that none of the liquidity withdrawal and higher interest rates matter, but for some reason they mattered a lot. Then in 2020, the reverse was done, or the initial reduction of rates and the injection of liquidity was done. So I'm saying that we don't know and we don't care beyond a point, but we don't want to play all or none in the sense that we have 15% cash just to show to ourselves that we are analyzing some news, that we are reacting to some news, and we are not giving this story like most of the other fund managers do, that if they don't have anything positive to say in the short term, they will say and believe that if you have a 5-year view, it's a great market. We also know it's a great market for 5 years, and you also know, and the third guy also knows. But we want to do well as much as possible relative to benchmarks, relative to others. And in the short term, I feel uncomfortable just because of the fact that I have seen for the last 15, 18 years, and actually 25 years, but I was talking more of the Helios days, that our markets to go down 5% never really needed a reason. And now we have 5 reasons and the market is like flat. So I feel uncomfortable, and for that I have some cash in this fund and a slightly lower net in our long short fund.
So, Samir, as we figure all of this out and storytelling, which is getting better and better, can I ask you that the recent correction that we had seen, what did you use it as an opportunity to enter?
Well, if you see, last month we have only bought 2 stocks. One hotel stock we added, and a little bit we added to the financials that we had, but we wanted to add. And also in Jan, we had trimmed a little bit the whole portfolio, thinking that the markets will anyway be not going up a lot this year. And I was expecting even in Jan, based more on the US Fed tightening and the reversal and their hawkishness, which then turned out to be absolutely right, and even more hawkish than anybody would have thought in Jan when I had gone to US. But then the Ukraine and other things meant that we really broadly haven't added anything because we are doubting the rally right now, except these 2 specific stocks.
Samir, not bad. I recall you said that you bought ITC because it's not going to fall too much. It's actually picking up 255.
And I also said, and in the same interview, I also said Lemon Tree. That was in early Feb or something, which is up some 30-40%.
Yes,
so
it is.
some of these work. That's okay. That is how we have survived for so long. So it's good.
So are you going to hold on to ITC now that it's finally begun the move?
Now we might as well go for the ride if it wants to go more, because who knows how far these things go. But so far, so good.
Samir, why are FIF lows so volatile? $1 billion. First, it was like this sell number which surprised everybody. Now suddenly it's like, you change the date and the flow pattern has changed.
No, you see, the thing is, in a big picture sense, why I feel a little uncomfortable in the short term is that we are in a bad neighborhood. Neighborhood means that we are part of a emerging market basket in which Russia is down to 0, China is down some 15-20%, and therefore the whole NAV can't be very good either year to date or even for say 6-12 months. And therefore any redemptions from that group, which is most of the money that comes to India, is not coming from like our fund, which is India dedicated, mostly comes from emerging market funds and all. That, whether those guys will choose to sell proportionately from China, or will they say now that China is trying to put a floor on the market, will they sell from some other market to feed their redemptions? Because I am assuming in a big picture sense that the fund manager of emerging market is not doing well currently. And so therefore, most likely he's not having great choices in terms of either what he should buy, but mostly what he should sell to, to move on and to feed the redemptions. And then now we find that even sovereign fund, I mean, what has happened to these Canadians? Have they blown themselves up in Russia or what? That they are selling our Indian high quality stocks, where the big picture assumption is that these are good stocks and you hold them for sort of nearly ever, unless there was something specifically wrong, which we don't believe was wrong in either of these 2 stocks. And they are selling $1 billion, and then whatever they sold yesterday, 500 million or whatever. So it looks a bit, this thing that it is not so much to do with India, but because the investor has done badly in some other markets, because India has not done badly. So it's nothing to do with India.
Samir, what happens when the LIC IPO actually comes in? Because, I mean, minimum for 15 days, you will see a big shake-off at least, because I'm guessing a large amount of liquidity would get sucked into it, or not?
No, absolutely. That is another thing. So I'm saying, therefore, just let's wait for 1 or 2 months. My initial issue was not so much to do with LIC, but to do with the fact that when the Indian companies, particularly in the consumer sector and all, give guidance and say that they are not able to handle this commodity rally. And by the way, you can keep saying that the oil prices have corrected, but what I saw is that year to date, which is only 3 months old, it's up 40%. And if the stock market is not down, then that is where we have to discount. We can't discount from the middle of the month and say from the peak it is down 8%. Because broadly, if I just look at it quarter to date, market is flat and oil is up 40%, which means many of these consumer companies and similarly commodities are up somewhere plus minus that, that all of them have to find it difficult to pass on these commodity price hikes, which is the part of their raw material over the next 6, 9 months, or maybe even a year. And therefore, can we just say, okay, doesn't matter. We have moved to 25 multiple, FY 25 instead of 24, and we roll on. My big picture bet is that some of these consumer companies go back, fall 30% from the top, simply because if I look at it from the previous time when the price was $100 for oil, and just take that as a representative of the entire this thing, then from that time to now, if I look at these stocks, their earnings have doubled. That is from 2014, and their valuations have tripled. So, in a big picture sense, if they were trading at a certain valuation in 14, there is no reason why today they should be trading at 1.5 times that, when the stocks were very well known even at that time. They were not some new discoveries. They were stocks that had been around for previous 20 years. And therefore, in a big picture sense, I think that from the top, these stocks will fall 30-35%, and they've fallen maybe 15%, 20%.
Saurabh Mukherjee says that some of the big companies will gain market share.
No, they can gain market share, but the valuation, if I look at in the US, if you look at, any new price appreciation that happened over the 3-5 years, it has been given up to go back to the longer term averages. You can see ARC went up some 200 odd percent in 20. But if you look at over the last 5 years, it is now in line with Mr. Buffett. If you look at Zoom, it went up some 200-300%. But if you look at it last 5 years, it has done worse than hotels. If you look at the fintechs there, they went up a lot. Basically, everybody in the end, in the valuations goes back. We are not talking about winning market share. We are only talking about valuation. If the valuation goes back to the time when commodity prices were high, and therefore when the commodity prices fell for the next 5-6 years, it was relatively easy to have a small price hike and say that what a great this thing that I've only increased prices 4%, but the commodity prices had fallen in between, and therefore your margins kept going up. Now is the time when you have to chase the margin, as in you are always behind, and you're thinking how much to increase and should I increase. For the last 6 years or 5 years, the commodity prices would fall and your price would go up by a small percentage and your margins were increasing. So now you're in a reverse situation. And therefore, in some sense, until we say that the markets were completely inefficient till some new fund managers came into the market, then the valuations of that time were reasonable assumptions, because they had been around for the previous 30 years. And I used to believe that our markets were very efficient maybe all our life.
Okay, Samir, I have a very basic follow-up question just for the benefit of our viewers. The headline yesterday was that the bond yields have inverted, which means a recession is coming. Recession means it's bad news for the world, bad news for the growth. But the second headline was that Fed will not increase rates and equity markets they went higher. So what is the right headline to understand?
That is my whole problem. But by the way, today on Bloomberg, PIMCO says don't look at this bond yield, the curve reversing, because then they say whether it should be 25-year and 30-year, 2-year and 5-year. There are some 100 stories. Bottom line is that I don't think the market is running away. Whether it falls or not, I still don't think it is running away. Therefore, relax, put your SIP money, but don't think every morning, and don't come every morning to these poor new retailers and say that every morning if you don't put money, God knows what will happen because it's 30-year you do SIP. If a guy is going to do a 30-year SIP, that means he is going to keep his job for 30 years. Everything is fine. He's going to be healthy. He's anyway won the bet of life.
So, Samir, taking forward from all of these news developments that have been coming in, and with at least the markets looking at the price action, indicating that the worst of the war might be behind it, at least as far as the stock markets go. The overnight fall that we've seen in commodities, the super cycle commodities that we were all talking about, do you anticipate that to be behind us, or just to get more reasonable, because inflation is a big problem?
So right now, I don't think it will solve, because it was not the leading the commodity prices to go up, but the sanctions that the US and others have put on Russia. So now in that, you can say that anyway, separately on oil and gas, they have not put the sanctions, and therefore it should not matter. But it still matters, because you saw these companies and these shipping companies and these insurance companies and the guys who move around this stuff all doing what they started calling self-sanction. And let us look at some commodity guy who was long Russian, some commodity, and shorted it in the futures to try and make some money. Now he's short in the futures, and in the cash market, and in the physical market, he's not getting delivery because it's not easy to move it around, or it's not easy to deliver it to whoever. There'll be so much mess that will be discovered soon. One guy lost how many $1 billion in nickel. So you really believe that in the whole world, only one poor fellow lost a few billion and the rest are all fine? My problem is that in 2008, I argued exactly like this and really spoiled my returns, and I will not do anything like that anymore in my life, because I learn. Some people want to all learn on their own account. I also learned from my own account that everything in 2008 I said was a positive. Either it is discounted by US, or then I said that it has nothing to do with us. HDFC Bank and ICICI Bank don't have any Lehman Brothers exposure or subprime exposure. But in the end, it turned out that we were all connected. And therefore, I'm saying, wait 2 months. I am not doing some great thing. I have only 15% cash. I just want to analyze and buy. It will not change my life. It will not change my investor's life, but that is how I am. I am not going to come and say it's a great 5-year plus story like other guys, because I am not like others. That's it. There's nothing more than that.
Yes, you're not a creative storyteller. I take that point, Samir Arora. But as the FIs start to stage a comeback, and a time when crude prices are going down, they seem to be gravitating towards healthcare. They're gravitating towards energy. They're not gravitating as much towards the financials as well as IT. Now, those were seen as the safer bets, the defensive plays. Did that take you by surprise?
On financials, the thing is that this angle was always there. Even we are mostly overweight in financials, that there is a high ownership. And when, for many years, when HDFC Bank and all are not in the MSCI index, and in 2013, it was the number one biggest company in the index. And then it was removed because of reaching foreign ownership limit. So we all never sold. Maybe others also obviously didn't sell. And for many years, therefore, it was not in the index, whereas the funds had it, and therefore it helped the funds because the stock did well. Now for 2 years or 1 year, when it initially didn't do well, the fund managers would have felt completely the opposite, that it is not in the index, and therefore it is not hurting the index, but it is hurting individual fund managers. So they have sold. Now, we are also stuck in some of these things when we know that fundamentally the company is improving every quarter, the growth rates are back, some of their issues are over, but there is a technical overhang, which actually can stop, because it was the same overhang was not there for 5 years when it was again not in the index, but funds had it. So we still hold it because we say it's part of our portfolio where you can handle a stock which is doing well fundamentally, but becoming cheaper every day. So we continue to hold this financial. I think it's basically a story of 2-3 financials where it's sort of a buy for everybody and it's not done well. But others, ICICI Bank, State Bank, how well they have done in the last 1 year or in 2021 separately, or if you do it rolling 1 year, We have no problem with that, and we don't care whether other funds are selling financials or not. Tech, I think in the end will work out the best because tech is still, there is a currency advantage, and secondly, not directly related to commodities. And see the US market or US economy is still better than everywhere else, so I don't feel too bad about that.
Samir, I was just telling Nikunj that the next interview, whenever you're in India, should be from Prince Pan Corner in Delhi.
Or could be from Nathu Sweets.
Wherever. Haldiram's bhi chalega.
Haldiram to bahut hi badhiya hai. Haldiram, I want to eat there every day so that when they go public, they give me anchor stock.
What chola bhaturas, man? I mean,
Forget chola bhatura. The best pav bhaji I've had is in Haldiram's Delhi and nowhere in Bombay.
Pav bhaji is Bombay, guys. No.
Not
I mean, don't talk like Delhi wala. Pav bhaji, I'll take you to Sardar Pav Bhaji with Samir next
I've
time,
had
and I can
Sardar pav
challenge
bhaji.
it. No, I refuse to buy that.
Haldiram's beats its
Okay, let
hand.
Samir decide. Delhi Pav Bhaji, Bombay Pav Bhaji. You've lived in both the cities.
I will eat in both the places to compare.
Arey, ye kya jawab ho? You've eaten both. You have to give me the verdict right now. You're being nice to Aisha.
No.
No,
He's only true to food.
Chalo, Pav Bhaji or Golgappa. Next time, Samir Arora, we have to meet him. We have to host you to chart both the places.
Perfect. So I am not being bearish, guys. I am just saying, there is a part of our job which is to analyze things and not just repeat a book from 10 years ago that if you invest for 20 years, it is very good. We totally agree with that. We agree with 5 year. We agree with 3-4 year also. But you still like to do all these things because otherwise how to, for 25 years, be in this market and do well is you have to be a little bit analytical and a little bit, whatever is the word. Okay.
Thank you very much. You've been very honest.
Thank you
We
very
appreciate that. Very rarely fund managers come and say, "हमारे पास 15% cash है." Otherwise, everybody.
अब जो भी होगा उसका वो बात नहीं है, but हम अपनी तरफ से जो हमें लगता है वो करते हैं. Thank you very much.
Thank you very much.
He's
Bye-bye.
saving it for Haldiram's. Okay, Samir, always good chatting with you. Thanks as always for joining in.